evening. My name is Marc Davenport, and welcome to Straight to the Top. We've got another great show for you tonight. A lot of information to share and talk about. But before we do that, I just have something really important that I like to say. Every morning when I wake up, I receive anywhere from 30 to 50 affirmations from people who tell me, who are saying to me, thank you. Thank you for staying positive. Thank you for the energy. Thank you for the motivation. It's phenomenal, and it means a lot. But it's important that you guys know that you encourage me more than I encourage you. And it's the encouragement, the love and support that I get that compels me, that motivates me to bring the absolute best that I have to offer to you guys every Tuesday night right here at 8 o'clock on Straight to the Top. So from me to you, I just wanted to say thank you. Thank you very much. You guys are appreciated and you mean the world to me. So we've got a good show tonight. And ladies and gentlemen, I want to share some information, some strategies that wealthy people, wealthy families, affluent families have been using for years. And there's a lot of information out there that we don't know, but that's okay because there are people out here that you're connected with that have access to all types of information, and we're committed to sharing that information with you. So tonight's topic is very simple, okay? Tonight's topic is about leveraging strategies, the same strategies that the wealthy and affluent people in this country use to take care of their families. So why isn't it okay for us to do what they're doing, right? So let me take a step back. Great information, great advice is only beneficial if it's applied. If it's going in one ear and out the other, it's moving on to someone else. So we've had a lot of people on this show share great information with you, from books to strategies to legal advice, etc. But ladies and gentlemen, understand, great advice and great information is only great if it's used. Otherwise, what's the point, right? So let's get into it, because at Straight to the Top, we go 30 minutes. At Straight to the Top, we want to give you information. Excuse me. We want to give you information. So over dinner tomorrow, when you wake up and go into the office tomorrow, and you boot up and turn on that machine, you can say, last night on Straight to the Top, Marc Davenport and his guests shared some information for me that I can leverage for my family. So here we go. We're going to talk about 4 things tonight. We're going to break it down in bite-sized chunks and make it very simple and easy for everyone to understand. We're going to talk about cash. We're going to talk about credit. We're going to talk about collateral. We're going to talk about contacts. And then we're going to talk about leverage. And if you work with me, if you've known me for any amount of time, leverage is one of my favorite words. So leverage, according to Marc Davenport, is simply a strategy that you can use to control an asset with very little skin in the game. Let me say that again. Leverage allows you to control an asset with very little skin in the game. If Tia McBride is on this show, she understands what I'm talking about. I'm going to give you a quick example. There's a piece of property for sale that Tia is showing me. Let's say the price is $100,000. And let's say in order for me to participate in this opportunity, my contribution, my skin in the game is 5 or 10%. Well, that's $5,000 or $10,000. So what that means, ladies and gentlemen, is that I can control an asset valued at $100,000 for $5,000 or $10,000. The spread the amount of money I didn't pay is leverage. And so one of the reasons why real estate, for example, is such an attractive investment, I can control 100% of an asset with 5-10% down or invested into the project. And there are very few other opportunities where you can control an asset for little or no skin in the game. Okay, so the first thing I want to do is I want to talk about families that have children. And whether your children are over 21 or under 21, I'm going to share some information that will position them to win. It's always about winning. There's no such thing in the RMI universe called breaking even. Because at the end of the day, you either make money, you have a profit, or you don't. If you have profits, you win. If you don't, you lose. So if you think it's okay to break even, somebody's giving you some bad advice. Here we go. If you have a child that's a teenager, 13 years old, if you have a child that's in high school, and you have reasonable credit, what I'm going to show you is how to position your child for an 800 plus FICO score. The max FICO score you can achieve is 850. And let me tell you something. For all the people that say they have an 825, 850 FICO score, let me tell you, there's nothing that they can't do that you can't do with a 750 FICO score. There's nothing that you can't do with a 740, 750, 760. 850, I'm not knocking it. But I want everybody tuning in tonight to understand that doesn't give you elite status. That doesn't give you access to any additional value and benefits a person with a FICO score north of 740 has. Okay. You have a child in middle school, high school. They're not off to college. You have credit. And on your credit report, your credit score is determined by your trade lines. Okay. Let me explain what a trade line is. A trade line is the activity that you have on an account, whether it's active or not. It's the history of the account. You have a mortgage. Okay, the mortgage is still current. The mortgage has not been paid. Every month, you're making a mortgage payment. That's a trade line. The larger the value of the account, the larger the credit line, the more significant that trade line is. You have a Capital One credit card. You have a $10,000 credit line. You're making payments on that account every month. You pay it off, or you're doing the smart thing. You're maintaining a balance that doesn't exceed 30% of your credit line. If your balance is $10,000, and if you stay under 30 or $3,000 or 30%, that implies that you're doing a really good job managing your credit. So if you are a parent with a child in middle school or high school, and you are current and active on your accounts, what I'm going to talk about is what you can do to position your child for success, because credit is very important. Credit is as valuable as cash, because credit enables you to use someone else's capital so you can use your cash to invest on your own account. I'll say that again. Credit is important. Credit allows you the ability to leverage, that's that word again, someone else's capital so your cash is freed up to build wealth for your own account. So, Mr. or Mrs. Parent, you have 5 credit cards. Your balances are less than 30% of the credit line available. You have 5 trade lines. simply the history on the account. Is everybody with me? You have two children, Billy and Betty. Get Bill and Betty cards that you have. You want to get an additional credit card for Billy and Betty. If you have 5, you want to get 2 credit cards for Billy and 2 for Betty, but you are not giving them possession of the cards. What you are doing is you're taking your trade lines and you're putting your trade lines on their account to build an excellent credit history. I'll say it again. You're taking your trade lines and putting it on your children's accounts to help them establish a credit history. So Billy and Betty now have 2 Capital One credit cards on their accounts. They are not in possession of the cards. You're responsible and you're staying below that 30% threshold. On occasion, if you exceed that, that's okay. But I know that you are disciplined enough whereby if you exceed that 30% threshold, you'll bring it back down. Billy and Betty are in the 7th grade. You're doing that for 5 years. And oh, by the way, during the 5 years, Capital One says, I love how responsible you are with your credit. So instead of having 2 cards at $10,000, now we're going to give you 2 cards and we're going to raise the line on your cards from $10,000 to $15,000 because your credit history is excellent. And oh, by the way, Billy and Betty were just blessed too, because the credit lines on their cards, since they're piggybacking off you, has now gone up to $15,000. So Billy and Betty both have 2 cards with a total credit line available of $30,000, and they've never missed a payment because Mr. or Mrs. Responsible Parent, you would never do that to your children. And you would never open a card in your child's name because you maxed out your cards and then put your kids in a position where you're going to hurt them instead of helping them. So let's talk about what just happened. We talked about what a trade line is. A trade line is the history of a credit account. That's all it is. So what we're talking about is positioning your children, okay, to build an excellent credit history so that when they graduate from high school and head off to college, your children will have a credit score 750, maybe higher, because they've never been late and they've managed their credit responsibly and they've never really exceeded that 30% threshold. And whenever they have, mom and dad brought it right back down. Billy and Betty were taught and told and trained by mom and dad exactly what they were doing. It wasn't a secret. So when the credit card statements came, when you logged into the account online, when you made your payments, when you showed the interest rates, when you talked about cash back, when you talked about points, you are explaining to your children the value of credit. I'll give you an example. Billy, Betty, I went to Best Buy. I bought a $900 computer and I used leverage because when the bill came in, I paid off the $900 balance. I had the money. But I have the money in a place where it's earning money for me. You see, wealthy people use credit to leverage someone else's capital, so their cash is used to make money or to invest for their own account. So I bought a $900 computer, and all I paid was the $900 plus tax. I didn't incur any interest because when the bill came in, I paid the bill in full. And Betty and Billy, if you do that, you'll be able to get anything you want anytime you want to, but only if you really need it. So, what did we just talk about? We talked about trade lines. We talked about positioning and leveraging your trade lines for the benefit of your children. Your children go off to college. You put your kids on a budget. You can spend $500 a piece on these credit cards, and I'll pay the balance off in full. You're doing that another 4 years. The parent is helping, not hurting their children. So when the children graduate from college, Capital One said, my goodness, you guys are no risk. You're de-risked. You're responsible. You're staying below that 30% threshold. And when you do, you bring it right back down. I'm going to reward you. I'm going to take your credit line from $15,000 to $20,000. So now Billy and Betty now have access to $40,000 in credit because mom and dad positioned them. So let's say after college, Billy and Betty, because of the family structure they came out of, excelled in school, and they have a job with ExxonMobil, salary starting at $70,000. They don't have any debt. They're very good with money. And since they don't have any debt and they're very good with money, they can continue the cycle of what? Leveraging someone else's credit and capital so they can take their cash and make money. So that's how I want everyone that has children that are not yet in college, ladies and gentlemen, position your children. This strategy will work, but it'll work if you're responsible with the credit and stay below that threshold. If you're in the 70+% of your credit line, you're not helping your children. You're hurting them. Ideally, you want to stay at 30% of the line and below. So now everyone knows what a trade line is. Everyone knows what leverage is as it pertains to a credit card. And I'll toss in a second word, which is float. Float means I'm buying something using your funds and then paying it back with my money when it's due. The example was Best Buy. I floated Best Buy for 30 days. I bought a $900 computer, cost me nothing out of pocket. I used Best Buy's capital, and when the bill came due, I paid it. I floated Best Buy for 30 days. That's the financial term. Okay? So that's what we talked about with children. There's one other part, then we'll move on. There's an IRS code called 529, which is the 529 college plan. The college plan was designed for parents and grandparents. It was designed for anyone to set money aside for a child's college education. Excuse me. Education is not exclusive for college. It can be used for prep school, private high school, etc. Education. The money that goes into this account accrues tax-free. Taxes are paid or due on whatever monies that you pull out. Put a lot of money in, put a little bit out, keep your taxes as low as possible. By the way, RMI Capital is not a tax advisor. Obviously, you want to talk to your CPA or your accountant for the details. Why am I telling you about a 529? A 529 has a beneficiary. You started early. When your children were born, you told your family, please don't buy me toys. Please don't buy my kids toys and clothing. Please don't buy my children anything that will depreciate in value. That's not the lesson I'm teaching my children. What I'm teaching my children is how we use our cash to build wealth by using leverage. So I have an account for Billy and I have an account for Betty. Here's the account number. So on Christmas, if you celebrate Christmas, the absolute best gift you can give to Billy and Betty is a gift of what? Towards their education. Just make the payment payable. That's the account number. Send it in. Thank you very much. So what did we just do? We just forced our family and friends to adjust their mentality and their mindset to ours. We told them, please, we're not interested in investing or spending money in anything that's going to be worth less tomorrow than it is today. The best gift you can make or give to Billy and Betty is the gift of education. Here's their account number. Please make a deposit or contribution towards their college fund. Billy goes to college. There's money left in the account. There's a beneficiary. That money goes to Betty. Betty graduates from college. There's money in that account. What happens to the money? That money can then be earmarked to another child, grandchild, niece, nephew, whoever you want it to be. And here's the really good news, because you showed Billy and Betty how to manage their credit. You showed them the significance of investing in something that would be appreciative, that would be worth more tomorrow than it is today, instead of spending money frivolously on stuff that's going to decline in value over time. That's all Billy and Betty know. So when Billy and Betty get married and have children, that cycle will what? Repeat itself. Only is the really exciting part. Billy and Betty not only learned what you taught them, but their knowledge base is expanded because they had an opportunity to take what you taught them and build onto it. In other words, more often than not, our children become smarter than we are, and they'll take it to a whole nother level. And what we just did by focusing on those two things, we put our family on the road to financial freedom, but we're not done yet. You have a car note. The interest rate on your car note is 4%. You only owe $5,000 left on your car. And you're thinking about taking the balance that you owe on your car and putting it on a credit card to pay off the balance. Ladies and gentlemen, financially, is that a prudent decision? Now I'm going to sit back and count to 3 silently, because everyone that's tuning in, please type in your answer. There's no wrong answer. I have $5,000 left on my card. My interest rate is 5%. I have enough available on my credit card to pay off the car note. And I'm thinking about paying off the car note, so what? It's done. Is that the right financial move to make? What factors determine whether or not I should do that? Okay, here we go. Depends on the interest rate. If your credit card, the interest rate on your credit card is significantly higher than the interest rate on your loan, on your car loan, the answer is no. Why would you pay off a 5% interest loan and exchange it for an interest rate on a credit card of 12%? Makes no sense. Okay. The takeaway here is Before you pay off debt, look at the numbers, do the math, and determine whether or not that debt makes sense to carry or pay off. That's what wealthy people do. But we're not done yet. You have a mortgage. You just got paid your bonus. You inherited money from your Aunt Lou. You have enough money to pay off your mortgage. What should you do? Ladies and gentlemen, what I want you to think about is this. Before you make a significant or important financial move, do an analysis. Include your children. Make sure they understand what you're doing. There are certain benefits to having a mortgage. You can deduct the interest and you can deduct the property taxes. If you paid off this mortgage on your home and depleted that cash, would that cash be better put to use in investing it someplace where the return on your cash would be higher than your mortgage? If you can't find a place to get a higher rate of return than your current interest rate, but if you can, do the numbers. We're not finishing. Had a conversation with a friend of mine today, and their company was acquired. And they went from working for a company that offered no match on their 401k plan to a match up to 6%. And so he said, look, I'm going to invest 6% in my 401k plan. My company is going to match. So now I'm saving 12% in my 401k plan pre-cash. How about those apples, Marc Davenport? Let me tell you what I did. I said, if you're in a habit of saving 6% of your money today, how are you going to retire tomorrow? If you're in a habit of saving 6% of your cash today, how are you going to retire tomorrow? If you're making $100,000 a year and you're saving 6% a year, you're only saving $6,000 a year. How are you going to retire if you're only saving 6% of your money? So let me tell you a better strategy. What if you put aside 14%, your company matches 6%, and now you're saving 20% of your income pre-tax before deductions? That's a big number. You're investing $20,000 a year. That's pretty good. We're not finished yet. Client of mine got a raise, 3%. They're ecstatic about it. I said, okay, you got a 3% raise. What are you going to do with it? The money was already spent, right? So here's what you do, ladies and gentlemen, if you're not self-employed and you get a raise. Whatever that raise is, you bump your contribution in your 401k plan by the amount of that raise. If your raise is 3%, you bump your 401k contribution by 3%. If it's 5%, you bump it by 5%, because what happens if you don't? You're spending that extra money. If there's anything you take away from this conversation tonight, ladies and gentlemen, that is, I want you to think about putting your money to work. Spending less, investing more, and teaching your family great habits. The credit card example, the trade line example we talked about. If you follow that practice, your children will graduate from high school or college with a FICO score probably in the top 10 percentile of people in America. And the good part about that, the exciting part about that, is that they understand why it's done. We do 30 minutes on Straight to the Top. Could we go longer? Absolutely. But we want to go in and we want to go out because we come back next week. A couple of people I want to acknowledge before we wrap. I want to give a shout out to the great Angela Marshall, also known as Arthur Stone. We spent 15 minutes together yesterday. 15 minutes, right? And one of the things she realized was she does phenomenal work for free. It's not free, but she's doing phenomenal work and she's not being compensated for that. So we gave her 2 new products. We reconfigured her pricing model. So for the same amount of work, she has more products. She gave herself a raise, she'll make more money, and she's now positioned to do a 5X on her revenue. 5X means 5 times her annual revenue. So if she's doing 100,000, for example, what we're saying is she's positioned now to do $500,000 a year. That's significant. I want to give a shout out to Philip Yates, who invited me to come to the Greater Houston Urban League tomorrow and take his students through a pro forma exercise. I have a lot of respect for this guy, like him a lot. And he also told me that this has been the most challenging part of the curriculum. If you're in Houston, if you have a business, if you're thinking about starting a business, maybe your numbers aren't as polished as you like them to be, come through the Urban League tomorrow, bring an electronic device with Excel loaded on it, and I'm going to stretch it. I promise you're going to learn something new. And then finally, one of my VIP clients, a very prominent doctor in town, is going to come through tomorrow. Because irrespective of where you are on the food chain, whether you're here or there, you can always learn something new. And Doc, I appreciate you coming out. Have a plan, practice, prepare, practice hard, prepare regularly. If you do that, you're going to perform. But you're not just going to perform. You're going to perform at a very, very high level. And you will no longer have competition because you will be the competition. And ladies and gentlemen, you do that and you're on your way straight to the top. Good night, God bless, and thanks for tuning in.